Hello financial fans, welcome back to another stock analysis. Today we'll be covering Target stock ticker TGT. Target is a prominent retail corporation renowned for extensive network of physical stores and robust online platform. The company offers a diverse array of products ranging from apparel and accessories to electronics, home furnishings and groceries. Target's commitment to delivering a unique shopping experience is evident through its curated selection, affordable prices and exceptional customer service. With its wide-ranging product categories, convenient locations and user-friendly online presence, Target has established itself as a popular destination for shoppers seeking quality merchandise at competitive prices. The company is currently sitting in a market cap of $60.4 billion, and their revenue in 2022 was sitting at $50 billion, and the dividend is currently 3.36%. 26% of their revenue comes from beauty and household, 20% from food and beverage, 19% from furniture and decor, 18% from hardlines, and the remaining 17% from various other income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT of Target has gone up over the years, going from $71 billion in 2013 to almost $110 billion in 2022. The average EBIT growth during this period is 2.2%, and this is no change in the margin of safety on this metric. The margin has gone down over the years, going from almost 7% to 3.6% in 2022. The average margin decline is 3.3%, which is a 5% increase in the margin of safety. The next two metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.44 a share in 2013 to $4.32 a share in 2023. The average dividend growth is 12%, which is a 10% deduction in the margin of safety. This with a payout ratio that is sitting at 73.5%, which is no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For Target, this is just under 2.5 years, in this case a 248% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital for Target is sitting at 8.6%, which is once again no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of Target. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Target going from 2014 to 2022. The average growth rate in a free cash flow annually during this period is almost 20%. And we'll be projecting a 10-year expected growth rate in a free cash flow of 10% every year. Applying this 10% growth rate, we'll get a future free cash flow and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a sum of free cash flow of $52.3 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $35.8 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $77.63, which is a 40.7% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Target going from 4 years ago to the current year. The average growth rate in the dividends during this period was 14.63% on average. And I'm projecting a future growth rate of all of their dividends of 6.5%. I will once again be using the discount rate of 8% in this valuation, giving us a dividend discount model price per share of $306.72, which is a 134.3% upside from this model. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Target is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. We go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $87.90 out of this model, which is almost a 33% downside from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Target, look at their stock price and the earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 29.70. All that's left to do to get a fair value out of this model is to multiply it by the earnings per share that Target is generating, which is $5.86 a share, giving us a fair value of $174.02, which is almost a 33% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average, it has been sitting at 2.05, while the current yield of Target is sitting at 3.31%, indicating that it's very much undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 24.80, while currently it is sitting at 22.54, indicating once again that it's slightly undervalued on this metric, giving us a fair value of $177.51, which is a 35.58% upside from this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at the final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $164.75. Our margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the margin growth and deducting 10% for the dividend growth, giving us a 20% margin of safety. Applying this margin of safety, we get a fair value of $131.80, and with the current price of $130.92, we get a very small upside of 0.67%, indicating that's very close to fair value at the moment. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.